So it's been a tough year for fixed income and for broader riskier assets given the volatility that we've seen. What it's meant is that spreads have widened quite considerably and generally yields have moved up. So the opportunity to invest in cheaper assets is clearly there. For us, we like the strength of the US economy, and so we've been focusing a lot of our attention there. We've also been focusing on longer dated corporate bonds in the US, given that we think that the amount of supply that has come there has pressured spreads and is likely to abate at some point during the latter parts of 2018 or into 2019. So that's been the key focus, and then we're also starting to see increasing value as well in the high yield market as valuations have come under pressure there. So from an asset allocation perspective, it's been a US focus. There's been pockets of opportunity that have come about in sterling, for example, where Brexit-related headlines have pressured valuations as well, so we keep monitoring that. And sector-wise, we still like the banking sector. We think that there are opportunities in insurance as well, and generally focused on the less cyclical parts of the market, given the fact that we're probably at the latter stages of this economic cycle, even if we don't think that it's due to end anytime soon. So there's been a lot of debate about how long the economic cycle's got to run. Are we due a recession in 2019, 2020, given that we've had nearly 10 years of growth? And our view is that recessions don't just come about of old age, or economic cycles don't just die because of old age. And the fact that we haven't seen the sort of animal spirits post the last economic downturn that we've seen in previous expansions has meant that we probably haven't built the same degree of excesses that central banks have to lean against, which means that this expansion can probably play out for longer than any previous expansion. We're not forecasting a recession in 2019 in the US, and I think that's likely to be key for the economy globally. There will be pockets of volatility, obviously. But the reality is we go into 2019 feeling fairly confident about the prospects for markets and for the length of this economic cycle. So we get questions all the time about, is the bull market for fixed income over? Are we likely to see a rout for fixed income prices? And whilst we do think that yields are set to rise from here globally, they've obviously moved a long way in the US during 2018. They're set to rise, in our view, in 2019 in the UK and in Europe. But I don't think it will be anything like a rout that some have been anticipating. We think it will be a gradual process. So to answer a question of whether we've come to the end of the bull run for fixed income, that probably is true, but there are other parts of, at least in the credit space, where we think that valuations are now a lot more attractive. So we would be avoiding taking interest rate risk where that bull run probably has come to an end, and focusing on other avenues like the investment grade bond market, where we're not convinced that that we're going into a bear market anytime soon. So the issues that we've been concerned about for riskier assets this year have namely been the tightening of monetary policy globally, so central banks looking to raise interest rates, the end of quantitative easing as we move from quantitative easing to quantitative tightening, and the geopolitical risks. So whether that's the Italian shenanigans, whether it's Brexit, whether it's Trump falling out with the Chinese, etc., etc. So those are very real risks, and I certainly wouldn't want to discount them. But we think that the repricing that we've seen in riskier asset classes has moved to reprice this risk, and so those are perhaps less of a headwind going into 2019. The obvious real concern is whether we have a recession on the horizon. That isn't priced. We don't believe that is the case, but that would be the biggest risk to, I would suggest, both equity markets and credit markets, corporate bond markets, if that was to play out. But as I say, that's not our central scenario. We think that the likelihood of a US recession next year in 2019 is quite low, and so we remain constructive on parts of the corporate bond markets.